So taking a look at the overall market picture, we're starting to see a big focus coming through on the banking front. In fact, this has been the noise for quite some time. We know that UBA, despite the fact that it's enjoyed significant gains, is starting to soften somewhat. What is your expectation on this front?
Thank you for having me, Eleni. Precisely, I think there's a lot of positive expectations from the financial results that we're expecting from banks. Basically, we've seen the reforms happen 2 years ago, and banks have gone through a difficult period over that time. But I think banks are starting to find their feet and move back into profitability. And we're expecting some pretty decent numbers from a number of solid banks, including First Bank, GTB, Zenith Bank, and some other mid-tier players as well. So the expectation is generally positive for banks in the industry.
Is this inflating the asset prices on the banking front? And do you think that those that still haven't taken part of the increase on the share price front, do they still have some time to, of course, take advantage of what we've been seeing with regards to the optimism?
Correct. I think over the last 2 years, banks have come down anywhere from between 50 to 80% in terms of their share price losses. And we think that there's significant upside and room for recovery. This year alone, we've seen banks generally appreciate by over 17%. And the expectation is that the banks should continue to do well, especially once the results from these banks come out. And we expect them to be in line with the good numbers that we're expecting. And also, I think importantly, we've seen some pointers in that direction where even companies in the consumer sectors that have released their numbers have done pretty well. So the expectation is that the recovery should continue in the banking sector as well.
Let's also touch on the general sentiment. It seems that a lot of retail investors have lost optimism when it comes to the overall market because they were burnt during the market crash and the market meltdown. Do you think that this is now going to, are we going to see a recovery in the overall sentiments? Or do you think that there's still some time to go before people become confident enough to allocate their money into the markets?
I mean, you're absolutely correct, Eleni. You raise a very good point. I think investors have been generally beaten quite substantially over the last 2 years. So there's been a general shift in asset class from equities to fixed income. And as you're aware, the rates in the fixed income market has been pretty aggressive. We've seen rates generally at mid-teens, double-digit rates, which investors that, don't have a huge appetite for risk are moving into the fixed income asset classes generally. But for more long-term, more institutional and sophisticated investors, some of them still have appetite for equities. But I think overall, for retail clients, we're seeing their appetite more diverted towards fixed income securities. And we expect that to continue in the medium term as well.
Well, let's just touch on some of the yields, because this appetite that we've been seeing in the fixed income market has actually dropped the yields within this space. Do you expect any kind of reversal going forward? And we know that foreigners have been also showing quite a bit of appetite for Nigerian assets overall, not only equities, but fixed income as well.
I mean, we still expect it to continue. We think that the aftershocks of the partial removal of the subsidy would continue to put some pressure on inflation. And we think that the CBN is a bit concerned about that. So we expect the concern for inflation to leave fixed income rates relatively high, somewhere around the levels that they're trading at right now, anywhere between 13 and 16%, depending on the tenor and the curve on the yield curve that investors are playing at. So, but generally we expect rates to still be at mid-teens for anywhere between 91-day to 3-year fixed income notes.
When it comes to what we've been seeing on the industrial front, and Giokos cement seems to still be one of the favorites, what is your prognosis with regards to industrials? Do you have exposure there? We keep talking about the banks, but we've actually seen some positivity coming through on some of the industrials as well.
Absolutely, you're right. I think that the industrials, we expect them to still do pretty well. They've been more defensive over the last year or so, so they haven't fallen as far down as the banking sector, and rightly so, because I think the federal government has put a lot more emphasis on infrastructural investments. And the expectation from that front is sort of leaving a positive sentiment in that market, and we expect that to continue. But I think industrials and consumer market are also going to continue to be defensive somewhat. But I think because they've done quite well, especially over the last year relative to the banking sector, obviously there's more room therefore for growth in the banking sector than industrials. That's our view.
Let's also just touch briefly on the naira. It seems that it's pretty stable at this stage, and the central bank is doing quite a good job with regards to managing liquidity into the market. Are you content with what you're seeing on the naira?
I think the short answer is yes, and I think CBN's case is a lot more robust now that oil prices are trading at multi-year highs. It's been trading at levels that we haven't seen since 2008, around about 140 or so. And we expect that to, continue at least in the immediate term. So long as the oil prices are high and the foreign exchange reserves are robust, we expect the CBN to have increased appetite to continue to defend the naira and ensure stability the way it's done over the last few weeks and months.